Hi everyone, it's MJ and welcome to episode 5 of the Actuarial podcast. Now before we get into the topic today, which is talking about travel insurance, I just want to do a little bit of admin. I have seen your comments on yesterday's podcast, and the one thing that made me smile was someone said that they do enjoy seeing my face compared to the little wavy line that we had with the first 3 episodes. So we're going to continue seeing my face. The other person's comment, I don't think they were that keen on seeing my face because they were like, why don't you have more graphs and pictures in the podcast? And the thing is, there's 2 main reasons why I don't want to do that. One is that it does take a lot of time to put in the graphs and all of that. And 2, I do want this to be a podcast. I do want this to be an audio experience that doesn't necessarily have to rely on visual. So I don't want to be like, hey guys, look at this graph. As you can see, this is better than that. I'd rather rely on just the voice so that it is something that people can listen to on their way to work or on their way to university when they're stuck in traffic. So I do read your comments. So let me know what your suggestions are specifically around topics. Because that's where we're coming up today. Sorry, you must excuse me. I've got my notes over here. So if I do look away, it's because I don't want to leave anything else. So yes, we are talking about travel insurance. I got an email from a guy, Mike Levison, and he asked 8 questions. So I like that. I like the enthusiasm. I think he's someone who hasn't started studying actuarial science, but I might be wrong. And his first question was, what role do actuaries play in travel insurance, and how do they do X, Y, and Z? So this video is going to be focusing on your first question. Other questions, we're going to touch on them, but I'm not going to go into so much detail. And your last question is very similar to somebody else's question, which is around, so the question is like, where's the actuarial field heading? And somebody else asked, how's AI and actuarial science gonna, are they gonna clash? Are they gonna kill each other? And I love that topic. We're probably gonna do that either tomorrow or sometime next week. So look out for that podcast. But like I said, let me know if you have any questions. Also, one thing just to talk about yesterday's podcast, we were talking about, is the stock market dead? Because Elon Musk is definitely not a fan of it at the moment, and I was reading, they're hitting him with quite some heavy penalties. He's got like I think it's a 10 million or a 20 million dollar fine that he has to pay to the people that lost money with that tweet of his. He has to have a lawyer from now on check his tweets before he says anything, and he's no longer allowed to be the chairman of Tesla. And it does sound quite horrific. So I think Elon has unfortunately got the short stick of that deal. But let's move into travel insurance. It's an interesting one. So what we're going to do is we're going to break it down and just go into a little bit more detail. Essentially, when it comes to travel insurance, there's 2 components to it. There is the whole idea that your baggage or the items that you bring or take with you on your holiday or your destination, that they get stolen. And there's also the risk that something happens to you. Either you get sick or something happens to your health. What is interesting though is that like traditional insurance, like for instance, household will cover theft of goods, and medical aid normally covers health. The problem is they normally exclude they have these exclusions when you travel. So you might, have your engagement ring insured, but if you have to travel to another foreign country, you kind of lose your cover. Same with medical aid. If you travel to, the jungles of Africa, you're going to lose your cover. And the reason why they do that is because when we move out of our house, the data shows that the risk increases. So we have the risk increasing when we travel. But the other problem is that the exposure to risk, and I'm sorry, I know I'm using a lot of actuarial jargon, but I do think that, mainly actuaries and people in the industry are going to be watching this video. It's not like a fun one like the actuarial jokes. But your exposure to risk is also controlled by the policyholder. Remember, as the policyholder, you can determine how long you want your holiday to be. And insurance companies don't think it's necessarily fair if they're covering traveling insurance and you've got one person who's traveling for say 6 months of the year and somebody else who's only traveling for 1 week of the year. It's not fair, especially when you're pricing as a group. I think as insurance becomes more bespoke, more customized, we can do that with technology. We might start seeing differences, in which case everybody will pay a different premium that is specific to their own individual risks. But until we get there, what insurance companies have decided to do is just exclude travel from a lot of their products. Not all, but a lot of the products. And what this exclusion has done, it's created a gap. It's created a gap in the market for people who do want to cover their traveling risks, do want to, have that protection in case their baggage gets stolen or they get, bitten by a snake or something like that. So there is this market. It is small. I mean, it is only $2 billion, which I know $2 billion does sound like a big number. Like if somebody was to offer you $2 billion to do a job, I mean, you will do the job, no matter how boring it is, because that is a lot of money for an individual. But as far as an industry goes, it is tiny. And I think the reason why it's tiny is because, one, the loss that you're covering is quite small. I mean, like I say, yes, an engagement ring getting stolen, it's a lot of money, but it's more relative to, say, your house burning down. Getting bitten by a snake and requiring medicine and all of that type of stuff, yes, it's expensive, but it's very tiny compared to being diagnosed with a dread disease such as cancer. So the losses are small, and also the exposure, it's like you're only on holiday for 2 weeks. That is also small, and that's why the industry is fairly small, because the risks that they're covering are small. And this is one reason why you're not necessarily going to see a lot of actuaries in the space, because when the risks are small, the losses are small, the duration is small, it means that the profits are also going to be probably quite small as well. And you'd rather spend money or allocate your actuaries to researching catastrophe bonds and cancer rates and those type of things where there are bigger risks, rather than allocating actuaries to these smaller things. Look, I think in time, hopefully this channel will help. As more and more people become actuaries, we can deploy them to use our magical abilities with these smaller industries such as travel insurance. So yeah, let me see if I've left anything out here with the notes. Okay, one thing I have put here is I think travel is becoming more popular. Not only is transportation costs coming down a bit, but we've also seen Instagram has increased the need or the desire to travel. And I know this because I love watching travel channels on YouTube. And often you hear the people saying, okay, no, we need to go here, we need to do there, so that we can get our Instagram pictures. And it's one of the things that I think millennials and maybe Generation Z as well, we tend to enjoy traveling. Also, we're going to be earning a lot more than the older generations, so we can afford traveling, which is quite an expensive luxury. So I think we are going to see the demand for travel insurance increase with time. But that might actually be a risk to the travel insurance industry, in the sense that the people selling it, say the guys who sell you your tickets and book your things, or your travel agents, it's a risk to them, because if travel starts becoming quite popular and very big, then we might see it getting swallowed back up by your traditional insurance. So household insurance might have a little tick box to say, do you travel a lot? And they'll be like, okay, cool, you've added in. Medical aids might say, do you want to have the medical aid plus that covers your travel as well? And then, we might see the actuaries start getting involved, and they might say, hold on, we can actually estimate the travel risk with using the person's age. And they might say people, between the ages of 18 and 25, they're in that whole, what we call the accident hump. They're more likely to go to exotic locations and do crazier things. Therefore, their risk is going to be higher. And we can use age as a rating factor to help us determine the price. So we could see actuaries getting more into this industry as it becomes popular. But then, like I say, the travel insurance product might get absorbed back into the traditional market. So yeah, I mean, why are companies selling travel insurance? Like, why do we see some of the companies doing it? if they, if they don't really have that many actuaries in, and like we said, the market's quite small, why do some people still compete? I think the reason is specifically just for brand awareness. You might, if you're an insurance company, you might want to have a travel product that travel agents can then sell, just so that people who are traveling see, oh, look, there's that insurance company. And then when they come to insure their car or something else later, they can say, hold on, I've used them before. We've got a little bit of relationship. We can go forward. And this might even be the case when travel insurance is unprofitable. So we might come across a stage where, let's say, selling travel insurance to, say, a country like Somalia, it's incredibly high. I mean, in the Americans, I think on their travel advice website, they say, if you go to Somalia, death is very, very high. I mean, it's quite a scary warning. So yeah, travel insurance to Somalia would not very likely be profitable, or otherwise it's going to be very expensive. And I think a lot of these companies will, well, what they'll do, because it's such a small market, they might be a loss leader. They might use it just as brand awareness, rather than just say not competing. Because what you want to do in this travel industry is you want to look at what are your competitors doing. If your competitors are charging $10 a premium, and you've done your maths and you can only be profitable at $12 a premium, then what you're going to do is you're still going to sell it at $10. The reason for that is you want to be price competitive, and you might, like I say, either be a loss leader, or you start doing something a little bit sneaky, which I don't like in the insurance industry. And this is where the industry does get a little bit of a bad rep, is that what insurance companies can do in order to make their product more profitable is introduce exclusions, excesses, and caps. So a cap is, say, we will only pay out $1,000 whether you get bitten by a snake or hijacked or whatever happens to you. There's a cap on that limit, on the payout. So that's one way to really reduce the risk exposure. The other one is to introduce an excess that says, okay, you pay the first $100, and then we cover whatever after. And then that eliminates a lot of the low frequency or the low paying, high frequency claims and helps with the admin. And then the third one is the exclusions. They can say, okay, what is the biggest risk? So let's say Somalia, dying by gunshots, let's just say, for instance, they could make that an exclusion, which kind of defeats the purpose of insurance. And that's why I don't like it. But this does come up with one of Mike's other questions. He says, how do actuaries in that calculate the risks of nuclear fallout, terrorism, riots, and all of that? And the simple answer is that a lot of them don't. Those will be an exclusion. So nuclear bombs, terrorist attacks, riots, these do get excluded. The reason for that is that if they did have them included, let's say nuclear fallout, it would affect a majority of the travelers in that area, and then the insurance company would be losing that independence. And one of the big keys to insurance is that each risk you insure, you want it to be a little bit independent, so that you don't have all of them claiming at once, in which case you don't have the reserves to cover for that. But like I said, that's one thing I don't like about the insurance market, is when they start introducing exemptions, excesses, and caps. It becomes very, very difficult for the consumer to compare the products. Like this travel insurance is $80, this one's $10, but this one's got an excess caps. It becomes very, very confusing for the consumer. So I don't like that. And I mean, what they'll normally maybe do is they'll take the experience of what's happened over the year. They'll say, okay, look, we lost money on the travel product, let's increase the premium. Or we made a lot of profit on the premium, we can maybe undercut our competitors and sell even more the following year. So I think travel insurance is using a lot of past data, past claims ratios to determine what their price is going to be going forward, rather than saying, okay, what is happening in various countries like Thailand? Is there disease outbreak there? Is this happening in Germany? What's happening up here in France? They use more past data than, say, current trends. That's my thinking. If you are an actuary working in the travel industry, or you are someone who works with travel insurance products, and you do have a different form of or different methodology of calculating the risk or pricing the risk, please let me know in the comments section below. But yeah, I think let's maybe end it off there. Like I said, as travel insurance becomes more popular, we might see more in-depth analysis. We might see more actuaries getting involved in the space. But yeah, talking about data analysis and the rise of technology in the workplace is probably going to lead us to a future podcast, which is how are actuaries and AI going to work together? Is AI going to replace us? Are actuaries going to be able to tame them? What is going to happen? So make sure you stay subscribed to see that podcast when that comes out. But let me know if you've got any thoughts or suggestions in the comment section below. And also, check out the website that I've launched called mjactuary.com. We've got some merchandise. We've got some T-shirts that we're going to sell for Halloween. I did it back in 2016, and some people bought it. It was quite cool with the little zombie model. We've now included vampire as well, so go check that out. It's quite cute, especially for Halloween coming up. But other than that, I think we're all good. We're 16 minutes. Ooh, I'm still making these things too long. I'm gonna try keep them shorter moving forward. Anyway, thanks so much for watching, and cheers.